The US dollar has once again found itself at the center of attention in the currency markets, beyond by high consumer spending metrics. Expectations of an interest rate cut in the United States now seem more distant, with any potential adjustment likely delayed until the later part of 2024, possibly between September and December. Today's inflation reports, closely watched by the Fed Reserve, and have shown that the dollar remains strong. Early rate cuts seem off the table as the data doesn't support such a move. Specifically, core personal consumption expenditures for March held steady from the previous months at 0.3%, excluding volatile items like food and fuel. On an annual basis, the PCE index rose to 2.7% in March, marking the highest level in 4 months. Amid rising inflation, the US dollar has strengthened against most major currencies, indicating robust market confidence in it amidst economic uncertainties. In contrast, the Japanese yen has emerged as the primary laggard. The Bank of Japan concluded its two-day meeting today without any changes that could bolster the national currency, maintaining the key interest rate at a range of 0 to 0.1%. The bank continues its bond purchases and strategy amid influencing bond yields and indirectly affecting the yen's value. In recent weeks, markets have been anticipating possible intervention by Japanese authorities, as even a historic shift away from the negative interest rates has failed to strengthen the national currency. The USD-GPI pair has seen significant movement, with the yen depreciating by 11% against the dollar. As the American trading session opened on Friday, the price approached a critical resistance level of 157 yen per dollar. A brief dip below 156.5 might indicate a potential intervention by Japanese authorities, although if this was the case, it appears to have been largely ineffective. While traders generally find it challenging to predict the next movement of the US dollar, its trend against the Japanese yen is quite clear. However, as stable as any trend may be, it still has the potential to weaken or even dissipate. This is vividly illustrated by Wall Street's response to the artificial intelligence boom. For a while, we observed the stock market and the national currency rising almost simultaneously, defying all the technical laws of the market. But while look far from examples, such a scenario was evident today as we prepared this report. The S&P 500 index was trading higher within the daily range of 5,073 to 5,103 points. The main drivers of its growth are still the stocks of IT companies such as Alphabet and Microsoft, which have surged on strong quarterly results. Here is an update on the US dollar index, captured at the same time as the earlier snapshot. The index is showing a green indicator, currently trading higher in the range of 105.40 to 106.10, and this trend highlights that the US stock market is advancing alongside the American dollar. This phenomenon has prompted some experts to wonder whether the robust performance of the dollar might pose an additional challenge to the global economy, especially impacting the Eurozone and its currency. Following the recent release of the US GDP data, the euro started a downward slide, a trend that today's consumer price data has further solidified. The Euro-USD currency pair initially tried to curb this correction and stabilize just above the crucial level of 1.07. However, this positive technical signal quickly faded, and the euro has continued to weaken now fluctuating within the range of 1.0650 to 1.0754. In this context, if the price can break through and sustain above the 1.07 mark by the end of the trading week, it could trigger a gradual rise in the euro's value, potentially reaching between 1.08 and 1.09. Conversely, if this upward momentum is interrupted and the price stays below 1.07, it would give sellers a second opportunity to drive the currency down to new local lows. Recall that on April 16-17, and the euro traded at the lowest level of the month, around 1.0610 to 1.0620. Brent crude oil futures are on an upward trajectory, having already recovered more than a half of their recent decline. If a Brent stabilizes above the $90 mark by the end of the week, it could signal the end of the correction phase. However, if Brent fails to maintain its levels, there could be a reduction in the buying activity. A decrease in the long positions could lead either to stagnation or to further sell-offs. In the former scenario, prices would flatten, while in the latter, they could enter a bearish zone. With the dollar currently strong, this downturn appears more plausible, unless disrupted by extraordinary political developments. This concludes the trading on the global markets for today, April 26. We hope this trading week has been profitable for you and that your investments are closing the week on a positive note. The InstaForex TV team wishes you a great weekend. We look forward to seeing you in our upcoming market reviews. Don't miss out.